This is OwlUp, where learning happens in minutes, not hours. For a deeper journey, explore all our courses at owlup.co. Now, let's dive in. Welcome to Chapter 3 of our series, Mastering the Stock Market, Frameworks and Strategies. In this episode titled Understanding Market Signals, we'll explore the various types of signals that can help guide your investment decisions. So, if you're ready to decode the market's language and enhance your trading skills, let's dive in! Traders once watched a single bond yield flip and quietly started preparing for a recession, more than a year before headlines caught on. In this episode, we drop you into that moment and explore how subtle market tells can whisper big shifts long before they're obvious. Those traders weren't guessing. They were reading a crowded dashboard most people never see. Beyond a single bond move, the market constantly broadcasts signals, earnings surprises that ripple through sectors, volume spikes that hint at quiet accumulation, option prices that reveal where big money is nervously hedging, and even abrupt shifts in social chatter around a stock. Think of a company's quarterly call. The numbers might look fine, but if the stock sells off on record volume while executives sound cautious, that clash between story and reaction is itself a signal. In this episode, we'll unpack how different types of signals, fundamental, technical, sentiment, and unconventional data often disagree, how professionals rank them, and why timing matters as much as direction when you're trying to separate meaningful hints from market noise. One practical way to think about signals is to group them by what they're really hinting at. How healthy is this asset versus how are people treating this asset right now? Fundamental clues lean toward health. Technical and positioning clues lean toward treatment. Then there's a newer layer, alternative data that tries to sneak a peek at reality before it shows up in official reports. Credit card swipes, web traffic patterns, even footfall sensors in malls. Professionals rarely trust any one lane. They're hunting for clusters, especially when different types of signals start pointing in the same direction. Start by noticing which signals tend to move first and which ones usually confirm the move. The 10-year, 3-month yield curve inversion, for example, has flashed red ahead of every U.S. recession since 1970, often long before earnings estimates get cut or unemployment rises. That's a classic early warning macro signal. It doesn't say when to sell a specific stock, but it changes the background risk level for everything you own. Now contrast that with something like a moving average crossover on a major index. Historically, simple systems have captured about 65% of the S&P 500's upside and avoided 70% of its downside. That's not magic. It's a way of turning noisy price action into a slow binary message, risk on or risk off. Notice what's happening here. The curve inversion warns that the tide may go out in the next 6 to 24 months. The crossover tells you the water is actually receding. Sentiment-heavy indicators often sit in between. When the VIX spikes above 30, the mood is usually panic, yet the 12-month forward returns have averaged around 15%. In other words, widespread fear has historically lined up with better-than-average future outcomes. A purely emotional reading becomes a contrarian timing hint, if other pieces of the puzzle don't completely contradict it. Then there's the fast-twitch world of alternative data. Usage grew at a 27% CAGR from 2016 to 2023 because big players want to see reality before the official reports hit. Think hedge funds watching parking lot traffic at retailers or tracking app download trends for a new game. These feeds can front-run both fundamentals and price, but they're messy, expensive, and prone to false alarms if you overfit the story. Putting this together, professionals quietly build their own signal stack. They might say, macro curves and credit spreads shape my risk backdrop. Trend signals tell me when to lean in or step back. Sentiment tells me whether I'm being paid to be brave. Alternative data gives me a small edge at the margin. One analogy, It's like a tech team running layered system monitors: hardware health, network traffic, user behavior, and anomaly detectors. No single gauge decides whether to reboot the system. It's the pattern across all of them that triggers action. The real skill isn't collecting more indicators. It's deciding which few you'll listen to, what each one is allowed to vote on, timing, sizing, or outright direction, and how much weight you give them when they disagree. Think of a stock like a player on a professional team. Fundamentals are the long-term contract, fitness level, and training habits. Great to know if they'll be valuable over years. Technical action is the current box score and plus-minus. Are they actually helping the team win right now? Sentiment is the crowd and media narrative, booze, hype, highlight reels, that can swing wildly based on a single game. Alternative data is the behind-the-scenes tracking, practice intensity, sleep stats, even how often teammates pass them the ball. Here's where it gets interesting. A player can have a superstar contract, strong fundamentals, while riding the bench because of a cold streak, weak technicals, and ugly headlines, negative sentiment. Another might be on a modest contract but suddenly getting more minutes, scoring efficiently, and generating buzz. Professionals don't just cheer for the best players, they look for moments when performance, perception, and usage briefly line up, then fade, and position around those shifts. Soon your watch list may resemble a cockpit, AI distilling torrents of feeds into color-coded prompts, retail apps piping in signals like notifications. That sounds empowering, but it also tempts twitchy, short-horizon decisions. Treat each new data stream like a rookie on the roster. Test it in a paper portfolio, track its hit rate across cycles, and only then give it influence over real capital. The edge will shift from having signals to curating and governing which ones you truly obey. Over time, you'll learn which hints deserve a whisper and which earn a shout. Maybe a sudden ETF flow nudges you to trim risk, or a macro release pushes you to stagger entry points instead of diving in. Your edge isn't predicting every twist. It's upgrading from gut reactions to a draft board where each signal earns its rank through tested, repeatable value. To go deeper, here are 3 next steps. 1. Set up a free SimilarWeb and Exploding Topics account and spend 20 minutes comparing search and traffic trends for 3 competitors you heard mentioned, noting where demand is rising or flat. 2. Grab a copy of The Lean Startup by Eric Ries and reread the chapters on Build, Measure, Learn, while literally mapping each loop to one market signal example from the episode. For example, pricing pushback, feature adoption rate. 3. Open Google Trends and 1 to 2 industry newsletters the guest referenced. Plug in the exact keywords they used, like your niche AI tools or no-code analytics, and create a simple 3-column spreadsheet. Signal, what's changing, evidence, data or quote, and possible response, test, kill, or double down. This was OwlUp, your daily step forward. To keep learning with structured courses and more insights, go to owlup.co. Until tomorrow.